Hi there, I'm Julie Price, and welcome to Juniper's Economic and Market Review as of December 31st, 2024. I'm so glad you're joining me today as we make sense of what's been happening in the markets and economy and how it might impact you. Between the U.S. election, shifting Federal Reserve policies, and much global unrest, there was no shortage of headlines to keep us guessing last year. 2024 went by like a year and a half, huh? But here's the good news. The U.S. economy proved to be impressively resilient. Consumers kept spending, inflation cooled down a bit, and the job market improved. As we move into 2025, all eyes are on the new administration. What kind of economic policies will they bring, and how might those decisions shape the future? These are big questions that investors like us will be watching closely. On the monetary policy front, the Federal Reserve has been easing interest rates thanks to moderating inflation and a stable labor market. But the road ahead is a bit murky. New policies could either slow the pace of rate cuts or even bring them to a halt if inflation rears its ugly head again. Now let's talk markets. Stocks ended 2024 on a high note, soaring more than 20% thanks to solid earnings growth and a boost from the AI revolution. Bonds had a bumpier journey but managed to recover even as interest rate volatility kept things interesting. That said, risks like high valuations and tight credit spreads remain, so staying diversified and nimble will be key in 2025. In today's review, we'll dive into three main areas. First, a look at how the economy and markets performed recently, including trends in growth, jobs, and inflation. Secondly, how the incoming administration's policies might shape the path forward. And lastly, we'll look at global opportunities across stocks and bonds. To help us out, I'll be using JP Morgan's Guide to the Markets, so feel free to pause the video anytime to soak in the details on the slides. All right, let's jump in together and uncover what's happening in the economies and markets.
For the U.S. economy, 2024 was another standout year, with real GDP growing at a solid above-average pace for the fourth year in a row. So what's behind this resilience, and where could the economy be headed next? Let's break it down. This slide takes a closer look at the key factors driving recent GDP growth. Since consumer spending makes up nearly 68% of the U.S. economy, it's no surprise that the strength of the economy is closely tied to the health of the consumer. In 2024, consumers were in great financial shape thanks to rising household wealth and 20 straight months of inflation-adjusted wage gains. This strength in consumer spending powered the economy, contributing a hefty 2.5 percentage points to the 3.1% growth in real GDP in the third quarter. Very impressive. Other areas have chipped in too. Business fixed investment has remained surprisingly strong, growing 0.6% in the third quarter, even with higher borrowing costs, supported by solid corporate balance sheets and fiscal stimulus. Government spending has also been steady. That said, not everything has been rosy. Home building has stayed sluggish due to higher mortgage rates, and a strong U.S. dollar combined with weak global growth has been a drag on our trade balance. Looking ahead, 2025 has some question marks. Policy uncertainty is creating a bit of a fog. For example, stricter immigration policies or aggressive tariffs from the incoming administration could drive inflation higher. Extending the Tax Cuts and Jobs Act, along with additional tax cuts that were floated during the campaign, could also add to inflationary pressures. Even with these potential challenges, a recession doesn't seem to be lurking just around the corner. As rate-sensitive areas like housing find their footing and consumer spending grows at a steadier pace, 2025 is shaping up to be another year of economic growth, likely at a more typical trend-like pace. In 2024, companies in the S&P 500 are expected to have grown their earnings by 9%, which is a strong showing. Looking ahead, analysts predict even bigger gains of 14% in 2025 and 13% in 2026. While these numbers sound exciting, they may be a little optimistic, especially since overall economic growth is expected to slow down. If inflation keeps cooling off, it could make it harder for companies to grow their profits. That said, with steady economic growth and supportive government policies, we still see solid potential for earnings to grow, especially if more companies beyond just the biggest ones start contributing to that growth. Speaking of the biggest players, the Magnificent Seven had incredible earnings growth, 31% in 2023 and 36% in 2024. But for the rest of the S&P 500, it's been a different story. Their earnings shrank by 4% in 2023 and only grew by 3% last year. The good news, in 2025, we expect things to even out more. The Magnificent Seven are still set for strong growth at 21%, but earnings for the rest of the S&P 500 could speed up to 13%. This broader growth is great news for the market. With more companies contributing to the overall success, we expect less reliance on just a few big names. This could create more opportunities for investors to find value in the market. Plus, with lower interest rates helping boost U.S. manufacturing, we're looking at a potential economic recovery that could give the market an extra boost. Inflation made good progress toward the Federal Reserve's 2% target in 2024, which gave the Fed the confidence to start cutting interest rates. However, in the last few months of the year, inflation slowed less than expected, causing some concern that progress might be stalling. For example, in November, headline inflation, CPI, rose to 2.7% compared to 2.4% just 2 months earlier. The good news? This bump was mostly due to how inflation is measured over time, not because prices are rising faster. Looking ahead to 2025, we expect inflation to keep moving in the right direction. Over the past year, prices for goods like cars and household items have generally been stable or even falling thanks to smooth running supply chains. Recently, though, we've seen a small uptick in goods prices, mostly because vehicle prices have risen. But with car inventories improving since the post-pandemic shortage, this pressure should ease soon. On the energy and food front, gas prices have been lower and food costs haven't risen much. Slower global demand makes big price jumps in these areas unlikely in the near term. Two areas that have been major contributors to inflation are shelter and auto insurance. Housing inflation has been sticking around longer than expected, but newer data on rental prices suggests it should return to more normal levels soon. Auto insurance costs are still climbing, up 13% over the past year, but we're starting to see some relief here too as vehicle prices stabilize. Overall, inflation is expected to keep cooling in 2025. While housing and auto insurance prices remain higher than we'd like to see, signs are pointing to these pressures easing. However, if new policies from the new administration are rolled out as planned, we could see inflation temporarily pick back up before continuing its downward trend. Here's a new slide in the guide that shows the history of tariffs. Over the years, economic globalization has encouraged countries to lower trade barriers like tariffs, making it easier to buy and sell goods across borders. In fact, U.S. tariff rates have been steadily falling since the 1930s. But recently, COVID-19 disruptions and rising geopolitical tensions have caused policymakers to rethink how open trade should be. The incoming administration is focusing on protecting American businesses and addressing concerns about unfair trade practices, with tariffs playing a central role in their plans. This slide shows what recent tariff proposals might mean. For example, if a universal 20% tariff is combined with a 60% tariff on goods from China, the average tariff on U.S. imports could jump to almost 18% in 2025, up from just 2.4% in 2023, according to the Tax Foundation. That's a big shift. It's unclear if these tariffs will be implemented exactly as proposed or if they'll be used mainly as a bargaining chip in negotiations. Either way, we expect tariffs to rise, particularly on goods from China. tariffs don't just make imports more expensive, they can also have unintended side effects. Higher tariffs could lead to rising prices here at home, and other countries might retaliate by imposing their own tariffs, which would hurt demand for U.S. exports. All of this adds more uncertainty to an already challenging economic environment, making it harder for the Federal Reserve to navigate its plans. Let's take a closer look at tariffs and their impact. In 2018, the Trump administration raised tariffs on Chinese imports from less than 3% to over 10% and imposed 25% tariffs on steel and 10% on aluminum from countries like Canada, Mexico, and the EU. These tariffs were mostly upheld by the Biden administration, reflecting a long-term shift in U.S. trade policy. While these tariffs aim to protect U.S. industries, they also raise costs for businesses and consumers, contributing to inflation. However, consumer spending has remained strong, supported by wage growth and savings, even as prices rose. Tariffs protect some U.S. industries, but also increase costs, highlighting the trade-offs of using them as a policy tool. For investors, this underscores the importance of understanding how trade policies affect industries like manufacturing, technology, and consumer goods. The incoming Trump administration has proposed several big fiscal changes, including extending the Tax Cuts and Jobs Act and lowering the corporate tax rate. At the same time, it has promised to dramatically cut government spending. This slide helps explain how these proposals could affect the U.S. budget and overall fiscal health. On the left side of the slide, we look at government spending in 2025 and how it's paid for. Achieving major cost cuts won't be easy. For example, non-defense discretionary spending, things like education and transportation, makes up only 12% of the budget. This means the administration might have to consider cuts to defense spending or policy changes to big programs like Social Security and Medicare. They've also proposed using money from tariffs to help cover the costs of extending the TCJA. However, tariffs only bring in a small portion of government revenue, and even with new policies, they're unlikely to make a significant dent. Plus, higher tariffs could slow the economy and reduce other tax revenues. On the right side, we explore what all this could mean for the deficit and federal debt. Extending the TCJA without offsetting the cost would add significant stimulus to the economy, but also increase the deficit. Over time, these deficits add up, increasing the national debt. Currently, the federal debt is 98% of the country's GDP, but is projected to grow to 119% by 2034 if things continue as they are. If the TCJA is fully extended, that number could jump to 130%. Other groups, like the Committee for a Responsible Federal Budget, estimate the debt could climb as high as 143% of GDP by 2035 if all the proposed policies are enacted. Since these changes would need to go through the once-a-year budget reconciliation process, they likely won't take effect until 2026. Once they do, we can expect them to boost deficits and potentially create long-term inflationary pressures. The labor market has settled into a healthier pace after the big post-pandemic hiring boom. Although recent events like strikes and hurricanes caused some temporary disruptions, job growth is steady overall. However, the Trump administration's plans to take a stricter approach to immigration could have a big impact on the labor market in 2025 and beyond. Immigration has played a huge role in rebuilding the labor supply after the pandemic. The Congressional Budget Office estimates that more than 80% of recent U.S. population growth has come from immigration. In fiscal year 2023 alone, Immigration Services approved over 2 million work permit applications, 70% more than the previous record of 1.2 million in 2022. This influx of workers has allowed businesses to fill jobs without pushing wages up too much, which has helped keep inflation in check. If immigration were to be sharply restricted, it could slow the growth of the labor force, especially given the U.S.'s aging population. Fewer workers could make it harder for businesses to hire, which might force wages to rise more quickly, potentially leading to higher inflation. Another positive trend has been the recovery in the labor force participation rate. While overall participation remains slightly below pre-pandemic levels because baby boomers are retiring, participation among working age adults, especially women, has fully bounced back from pandemic losses. Looking ahead, steady economic growth and strong corporate profits should continue to support hiring at a moderate pace. However, if immigration is drastically reduced, it could lead to a combination of slower economic growth and higher inflation, as businesses face challenges finding enough workers. 2024 saw real GDP growing above its long-term trend for the fourth year in a row. But what's behind this economic resilience, and what might it mean for the year ahead? Let's take a closer look at one key piece of the puzzle, the job market. After rising earlier in the year, the unemployment rate has found its footing. By November, it had stabilized at 4.2%. While this is higher than the April 2023 low of 3.4%, it's worth noting that 4.2% is still incredibly low by historical standards, better than what we've seen nearly 88% of the time over the past 50 years. So what's next for unemployment in 2025? With steady economic growth likely continuing, we should see more job gains, which should help keep unemployment from rising significantly. And if labor force growth slows, possibly due to more restrictive immigration policies, unemployment might even tick lower as the year progresses. When it comes to wages, things are calming down too. Over the past year, a looser labor market has eased the pace of wage growth. After peaking at a whopping 7.0% in March 2022, wage growth has steadily moderated, landing at 3.9% year over year in November for private production and non-supervisory workers. That's right in line with the 50-year average, a sign that things are stabilizing. Of course, slower immigration could put some upward pressure on wages, but here's the silver lining. Sustained productivity gains could help offset that and limit any potential impact on inflation. As we move into 2025, the labor market looks poised to remain a source of strength for the economy. A healthy mix of job stability and wage growth should support continued economic resilience while keeping inflation pressures in check. With declining inflation and the job market showing some signs of slowing, the Federal Reserve cut interest rates by 1% or 100 basis points in 2024 to help support the economy. Looking ahead to 2025, the Fed would prefer to keep lowering rates until they reach a more neutral level. However, new fiscal stimulus, as well as potential tariff and immigration policies, could make that harder to achieve. At its final meeting of the year, the Fed reduced rates by 25 basis points, bringing the federal funds rate to a range of 4.25% to 4.5%. This move didn't surprise anyone, but investors paid close attention to Fed Chair Jerome Powell's press conference and the updated economic projections. Powell expressed optimism about the economy's overall health, noting that risks to the job market have eased. However, he also pointed out that inflation, while improving, has been running hotter than expected recently. The Fed's economic projections reflect this mixed picture. For 2025, they now expect stronger economic growth, lower unemployment, and higher inflation than previously forecasted. Because of these factors, the Fed scaled back its plans for rate cuts in 2025, projecting only 2 cuts instead of the 4 they'd anticipated back in September. They also raised their estimate of the neutral rate, the level at which interest rates neither stimulate nor slow the economy, to 3.0%. Right now, the market is more cautious than the Fed, with investors worried that inflationary policies proposed by the incoming Trump administration could slow down or pause the Fed's plans to normalize rates. A slower path for rate cuts is the most likely scenario, meaning rates may not drop as much as some had hoped. Until there's more clarity on the new administration's policies, the Fed's decisions will depend on how the economy performs in the months ahead. The S&P 500 is looking pretty pricey right now with its price to earnings or PE ratio, how much investors are paying for $1 of earnings, sitting at 21.5 times compared to the 30-year average of 16.9 times. That's near levels we last saw during the dot-com bubble. Other measures like price to book and price to cash flow ratios are also higher than usual. While these valuations don't predict short-term market moves, history shows that higher valuations often lead to lower long-term returns. A big reason for these high numbers is mega-cap tech companies. The 10 largest stocks in the S&P 500 have an average PE ratio of over 30, about 1.5 times their historical norm. What's more, these 10 companies now make up nearly 40% of the index's total value. That's a lot of weight riding on a handful of companies. If we look beyond these top 10 stocks, the rest of the S&P 500 is still expensive, but not as much. The average PE ratio for the other companies is under 120% of its long-term average, which could mean there's more opportunity in these lesser talked about names. The good news, there's a lot of variation in stock valuations right now. The gap between the most expensive 100 stocks and the cheapest 100 stocks is wider than it's been about 90% of the time over the past 28 years. This means some stocks might be overpriced, but there are plenty of others that could be undervalued. While this mix could cause more ups and downs in the market overall, it also creates opportunities to uncover good deals, especially as earnings growth becomes more evenly spread across different sectors. This slide looks at corporate bond yields and how they've changed over time. Yields are what investors earn for lending money to companies by buying their bonds. Right now, the extra income or spread investors earn for taking on the risk of lending to corporations is very low compared to historical levels. This is because companies are doing well overall. Earnings are strong, fewer companies are defaulting on their debt, and credit quality has improved. While corporate bonds may seem pricey by historical standards, they still offer attractive yields for investors looking for income. In other words, even if we don't expect those spreads to narrow further, bonds are still a good option for generating steady returns. The economic outlook for 2025 is positive, with a healthy economy and strong earnings expected to keep these spreads stable. As the Fed is likely to lower interest rates slowly, it's not the best time to make big bets on long-term bonds. But for investors looking to boost their income, corporate bonds can be a great choice. U.S. stocks have been on a fantastic run for years, but international stocks have often lagged behind. That could change in 2025. U.S. stocks now account for over 67% of global stock market indices, even though the U.S. contributes just 25% of global economic growth. This shows how expensive U.S. stocks have become, making it a good time for investors to consider diversifying into international markets. While some international markets are dealing with short-term challenges, there are long-term trends that could drive strong performance in certain regions. In Japan, after years of deflation and slow growth, their economy is starting to pick up. Rising prices are helping consumers spend more, which boosts corporate earnings. On top of that, improvements in how companies are managed are attracting more investment. While China's growth might face ups and downs, other emerging markets look promising. Taiwan has been a standout thanks to its leadership in tech and AI, and it should continue to benefit as the tech industry grows. Meanwhile, India has seen strong performance, supported by earnings growth and a boost in services exports. Although India's stock market is pricey right now, its long-term outlook is bright. This slide highlights how different countries' stock markets have performed. This variation creates opportunities for investors to explore specific regions without giving up on good returns. For those heavily invested in U.S. stocks, it might make sense to take some profits and spread investments across global markets. Historically, international stocks have been cheaper than U.S. stocks due to factors like less liquidity, economic risks, and currency concerns. But right now, the price gap between U.S. and international stocks seems bigger than it should be, making international markets particularly attractive. Semiconductors are incredibly complex to produce, involving many steps and specialized technologies, which means the benefits of chip production are spread across the globe. Currently, 72% of semiconductor manufacturing happens in Asia. ASML, a European company, leads the way in designing and building the advanced machines and software needed for chip production, and its biggest customer is in Taiwan, a major hub for the industry. Taiwan Semiconductor stands out thanks to its expertise in design and intellectual property. South Korea, on the other hand, excels in producing high-bandwidth memory chips, which are essential for powering artificial intelligence technologies. Meanwhile, countries like the U.S., China, and Japan are making big moves to grow their share of this vital market. When it comes to the materials that make all of this possible, China dominates the mining of rare earth minerals, accounting for 68% of global production. These 17 minerals are essential for a wide range of technologies, from phones and electric vehicles to medical imaging equipment and wind turbines. While not exactly rare, they are tricky to extract and refine. Beyond rare earths, other countries specialize in key resources. Taiwan leads in lithium production, vital for batteries, glass, and ceramics. South America is rich in copper, crucial for electrical wiring. Canada and Mexico are top producers of zinc, which helps prevent rust on steel. Nickel, primarily used in stainless steel, comes mainly from Asia-Pacific countries, excluding China. Africa is a leader in cobalt production, which is essential for batteries and other technologies. The interconnected nature of the semiconductor and resource supply chains underscores the importance of global collaboration and specialization. However, as countries compete to secure larger shares of these critical industries, shifts in trade policies, geopolitical tensions, or supply chain disruptions could have a significant impact on economic stability and growth. For investors and policymakers, keeping a close eye on these dynamics will be essential as demand for advanced technologies continues to grow. As we wrap up this quarter's review, let's take a look at how different asset classes performed for 2024. U.S. large-cap stocks were the big winners again, just like in 2023, delivering an impressive 25% return for 2024. Next in line were U.S. small-cap stocks, which gained 11.5%. The traditional 60-40 portfolio had a strong year, returning 10%. High-yield bonds also performed well, with a 9.2% return. Emerging market stocks grew by 8.1%, followed by real estate at 4.9%, and broader fixed income investments at 1.3%. The good news? Every asset class ended the year in positive territory. That's it for this quarter's economic and market review. Thanks so much for watching all the way through. If you'd like to discuss any of this in more detail or anything else about your investments, don't hesitate to reach out. I'm always here to help.